I got a guest on today. He runs a turnkey investment company, but we're not going to try and shove turnkey rentals down your throat. His name is Chad Daniel. He runs Turnkey Iowa, but he's coming forward as more of a passive investor mindset and moving on his passive portfolio side. Like many of the guests that we bring on here, Chad and I go way back, I think like 2017, 18. We did a deal back there one time and we met face to face. And at that point, it was cool the things that you guys were doing with you got some of your buddies together and you built a little company. But more importantly, you built your personal portfolio along the way. The reason why I wanted to bring you on today is because you represent a subset of our audience that had owned rental properties. Maybe you dabbled a little bit with doing that young kid burr strategy. You tend to be in real estate for more than 5 years. Your net worth tends to increase and your time is more valuable than money, especially as you become older and you got kids and you'd rather spend time with them or with your hobbies. But let's start with a little bit at the top, Chad. When did you start to get into real estate? And obviously, you're working a full time day job. Paint the picture on how you began here.
Yeah. So actually, Lane, you and I have some similarities here in our background. I went to engineering school, have that very technical type mindset. Boy, 15 to 20 years ago now.
When did you graduate college?
2007.
Yeah, same year as me.
Yeah,
Same
is it?
year. Yeah.
Okay, boom,
Yeah.
lockstep here. And I'm sure we'll tease this out through the rest of our discussion, but you've been one step ahead of me in the wealth elevator concept throughout time. And so it's been interesting for me to watch and see the things that you've been doing, the good content you have for people following you over time.
And I
So
think
go
yourself
ahead.
too, right? Like you like to help out people and now you're a OG to some extent. You've been doing this for well over a decade plus, and it's about sending the elevator back down. And that's what we really wanted to tease out these steps because there's so much useless information out there. I got 10,000 units, blah, blah, blah. But I think the most important thing is like the getting started part. So you graduated 2007. How long did it take you to save up to buy the first property and how did it all get started?
Yeah, the few years after 2007 were, of course, interesting in our economic world. So we had all sorts of things going on with credit markets and housing prices. Through that time, I was doing a lot of learning. I was also leading a small investment group. We currently have 5 people in this investment group that we started back then. And we were investing in stocks. So we were picking our own stocks and doing investments. So not syndications or funds of them, but we were doing that ourselves. And through that time, basically piling our capital together, our knowledge together, and learning about real estate. And that group started buying investment properties in 2012. Actually, my wife and I started in 2011. One of the pivotal points for us was in 2011 when we had not yet bought any rental properties. We were out looking at single family rentals. There were tons of foreclosures on the market, and we found several that we were placing offers on, and we got 2 offers accepted. So we were hoping to go find one rental property and start learning. Boom, within a week or 2, we got 2 offers accepted, and that was a big turning point for us to sit down and say, "Okay, we've done all the research, we've done all the learning. It looks like this works. We wanted to try it with 1. Are we confident, and do we go with 2 or not?" And we went with 2 and basically have not looked back. Our own portfolio has grown significantly since then. Our investment group single family portfolio has grown significantly since then. And we just kept working and learning more about mainly single family homes and mainly in the Des Moines, Iowa market.
Before 2012 or what was the
We
living
did. Yeah,
situation?
that was in 2007. We bought a primary residence.
Where'd you get the down payment for that? Like parents or
I don't remember specifically, but throughout college, we had summer jobs. We had started, I think we had maybe 9 months of full time work under our belts, or maybe I had 9 months and my wife had almost a year and a half, and really with college level expenses still. So I think with all that combined, we were able to pull together the down payment.
Your guys'
We
pedigree is just very extreme savers and good with their money. And another thing, you guys are in Iowa too. It's a little bit cheaper than California. So that's what knocks people out in their first stage of the basement level of the wealth elevators, buying that house. But
Yes.
um,
So for calibration, that first primary residence we bought was probably 1,600 square feet above grade, and we paid $165,000 for it. Then in 2011, when we bought those 2 townhomes, we were paying 60 to $70,000 for 1,500 square foot townhomes that were 10 years old in this area. Not anymore. Those prices have gone up significantly, but really the barrier to entry was significantly lower than many places in the country.
so you did it on your own on the first go round, and then you implemented investing with some of your buddies. Were you the experience lead out of that little, yeah, take us through how that all came
Yeah.
together, right? Like you guys drinking beers and how did you guys all know each other?
So yeah, drinking beer, that's how most good things start. Actually, we are all from the same area. Most of us went to college together, and we started getting together just to keep in touch after we graduated from college. Started meeting at a local pub one night a month and would just chat about things like jobs, whatever. And that evolved itself into something more and more formal and more financially focused. That group had done a lot of the learning and the research about rental properties, and that gave us enough confidence to personally buy some, but we didn't yet have a good operating agreement and all of that structure in place to buy investments as a group. So it took maybe a year until we had all that foundation in place and ready to go, where we were comfortable buying things worth 50 and $100,000 as a group together. So it was
And
really the lag to get our formal operating agreement put together and in a way that we were comfortable with.
I want to dig into the formalities just in a bit, but I wanted to highlight this is one of the big things that most investors don't have is like a little group or a little mastermind with these like minded people. Most investors don't have anybody in their circle, let alone accredited or even dabbling with rental properties. And that's just very clearly here the secret to success. And you guys weren't wealthy and you guys were just a bunch of dudes in their 20s at the time. But this is very critical to what I had. And that's unfortunately, if you're in your 40s or even past your 30s, it's very rare to meet anybody on this trajectory at that point, let alone in your physical network. But you guys need to be doing that. Or if not, you become in your 50s and 60s. Maybe you're happy, but you're lonely in terms of people following this trajectory. And I think what you're going to start to see now unfold, I'm sure Chad will go into this, is how things exponentially accelerate in terms of the knowledge network. Maybe here's some of the juicy stuff. It started with stocks and it was just more financially minded, then went into real estate for obvious reasons. You say there's 4 or 5 guys, right? But it was probably other guys involved initially, right? That kind of faded into oblivion. I
E
thought you're gonna say, "Oh, I don't remember them. I
well,
don't wanna hang. We
no,
don't see them anymore."
in the starting number for calibration, the group at the pub started between 5 and 7 or 8 people, and through the first couple years, we added and subtracted a few people, and it wasn't really deliberately subtracting people, but basically, they liked the friendship and pub part of things a lot more than the, "Oh, we're, like, taking minutes and contributing capital and having homework." That's a different type of friend than those you go have a good time with, but it's purely social. And so there was some self-selection out of the group. At the same time, we were meeting a lot of people through our jobs and careers and new social networks as we left college. And we would say, maybe this person would be interested in just coming and talking with us. And eventually they would join on. And that has stabilized out into 5 people in the group. And that's been steady probably for 8 or 10 years now.
Yeah. Just like any partnership, like once it hits a certain point, you ain't bringing anybody new in. They just can't add value unless they're one of the starting band members. That's why you gotta get around other people early in this whole thing because that's really the only entry point. But let's talk about you guys actually formulated this because most times I see these little buddy drinking beer, investor parties. There's no operating agreement. Maybe tell us a little bit generally how do you guys structure it and what any lessons learned there?
Yeah, we spent a long time structuring our group and our agreement, and we thought through 50 different scenarios probably of how things might go well or poorly and make sure we had plans in place and we had a document that was written and all of us signed it. We would dust off and bring out when those challenging times happened. Maybe just to talk through a few of those key things, we structured the group essentially like a mutual fund, meaning we always have an asset value, like a share price, if you will, and people are able to add or subtract funds at any time. So that's the sort of mathematical foundation of how this thing works.
A
But of
NAV,
course,
NAV, if you guys Google
yeah,
that and you watch a few YouTube videos, it's not the hardest thing in the world to figure out.
yes. And it's very powerful because as people go through different events in their life, they might have a chunk of money that they'd like to put in or a chunk of money they'd like to take out, and that stuff happens. To protect the group, we have some limits on how fast people can contribute money, right? So I couldn't today, for example, go to my bank account or write a check for $10,000 and just shove that into the group without a group approval of that. So we have some rules on the input side of funds. And of course, due to the liquidity challenges with real estate, we have some rules on taking funds out of the group. So I couldn't take 10,000 or $100,000 out of the group today without consulting with the group and getting approval for that. Structuring it as a NAV value and then having throttles or restrictions on money in and outflows were really keys.
It's a legacy type of fund. It's not 2000, like 2017 to 19, and then the next volume and the next volume. It's a
Correct. Yep. So this NAV has existed for, I don't know, 10 years or something. And different underlying assets have been added and subtracted from that fund.
which is difficult in the beginning because until your little group of men and women are solidified, you're gonna have people come in and out. And I guess the NAV kind of accounts for predetermined exit values when you want to kick somebody out or they're not down with the cause. But I can see down the road, you guys are still young, 10, 20 years from now, being tax efficient is to take a loan from your fund and maybe even getting warehouse lines, portfolio loans from a bank off of the fund value. And that way you can extract money out of this thing, similar to HELOC. But yeah, some
Yeah.
interesting benefits to doing it. But yeah, definitely headaches in the front end.
Yeah. And we haven't done any, or let me say what we have done. Almost all of the properties that we own are financed one by one. There are a few exceptions where it's two or three properties together or five together in a pool, but currently they almost all of them have their own individual loan that we put in place at the time of purchase.
And one of the five guys co-signs or puts the loan in their name and they get compensated a little bit more.
We actually all co-sign and it's a prorated amount based on our ownership, but we're signing on the line with our names. And for example, if I'm a 25% owner, I'll typically have a liability in the 25% range of the total. So we haven't gone the route that I've seen with more syndications where maybe somebody is the person that comes in and signs on the loan. Somebody brings a huge chunk of capital. Somebody brings the deal. And Lane, I'm sure you can list those different roles much better than I can. We haven't done that basically because of how we grew up on the same level and at the same time through this group.
You guys are brothers at this point.
Yeah, the twin brothers even. So all the same age, the same experience level. Yeah.
Yeah. Whereas in the syndication world, there's a rubric for the stuff
Yeah.
that we can come in and out because in the syndication world, it is a bit of a swingers type of world. You need to have that rubric to make things fair and square for
Yeah.
everybody.
And different people bring different things to the party in a syndication, right?
Yeah. And I think going deeper in on your guys' structure, I can see one big thing that happens is, and this is where I've always tried to stay away from these large partnerships because when you have more than three people, who's accountable? Nobody's accountable, then no, it never gets done, right? With five people, I
Yeah.
could imagine that people, you have one person that arises as the lead operator who's doing everything and that sucks for them and they should get compensated more. Has this happened? Have you guys gone around this?
Yeah, it's ebbed and flowed over time as what we were doing has changed, meaning there was a time when we were in heavy acquisition phase. There was a time when we were in heavy focus on operating cost time. Now we're doing some selling through the life cycle of some of these assets. The needs and the focus has changed. What we've done is assigned people clear roles. So people have their swim lanes in terms of the things they focus on. Maybe it's accounting and finance. Maybe it's finding properties to purchase. Maybe it's disposition or selling properties. So we've developed swim lanes for ourselves, which gives people that path, that line to work in. That worked really well because we have ambitious people in the group, but it stopped working as well as people got their own businesses that they own and their own portfolios and larger families, and life just got busier. And so, actually, for that reason, among others, and we can talk about those, we are looking to move into more passive investments. So, if I think about a single house, we maybe put $10,000 down payment on that house 10 years ago. It's been a rental ever since. Appreciation happened. We paid down the loan. Now we sell that 10 years later and we get a $100,000 check. And can check the math. That's about the reality of how these homes have worked so far. We now have this $100,000 check, and it's our intention to find more passive opportunities in syndications to invest that money rather than more hands-on active activities where we own the properties ourselves.
Yeah. Y'all are growing up. Time is more valuable than money, right?
That's right. We're looking to make a trade, and we
Yeah.
probably will no longer achieve the 25 or 30% rate of return that we've seen, but it's worth trading some of the time away that we have spent to make that happen to invest these larger chunks of money.
Yeah. And that threshold changes. And it doesn't change overnight with your entire portfolio. It titrates down slowly, but it reminds me I saw this news headline that the guy who won the latest lottery, his cancer is probably gonna pass away very shortly, right? That's an extreme data point. We all need to understand that life is not endless, and at some point, you need to make this switch that we're talking about very wisely right here. If anybody wants additional reading on this, amazing book is Bill Perkins' Die with Zero. He was on the podcast last year. I think if you go to the YouTube, I was able to ask him, I actually read the damn book, which is very rare for a podcaster when you interview somebody like that. But I was actually able to ask him a bunch of questions that I found interesting, and hopefully you do. But yeah, so you want to get on the fat and lazy couch now, right?
At least one foot on the fat and lazy couch instead of zero. Yeah.
Yeah, yeah. What are the issues or like the questions going at your stage? You're coming from this as more of an experienced investor. And as I explain it, it's a, for most investors, this is a little bit of a black box, right? How the operation works. But you
Yeah.
understand what is in that black box. It's more about understanding the box from the outside, looking from the outside in.
You'll have the name of this lane, but you have a 4 to 6 part series on the basics of syndication investing. What's the name of that?
I think the LP syndication e-course. So yeah, so people
Yes, that's right.
who sign up for the club, it's a free club. I don't know why you wouldn't, but yeah, we give you guys access to that. It's about 8 to 10 hours of more technical kind of knowledge. You're not going to be an underwriting specialist, but at least it gets you majority of the way there.
Yeah, so that's a great place to start, in my opinion, and our investment group has all watched/listened to those, so we are at least using some of the same terms because we might understand how things work in a single family home and market. So we understand how the the deal generally works, but there are different and specific terms in syndications. So making sure we have the right language has been important. And right now we're out talking to different syndicators. That's one path of work. And the other is mapping out what we really want. Do we want more of a stable cash flow type of performance or more of a payout at the back end, a development sort of opportunity, for example? And what markets do we want to be in? Let's say, do we want to be, for example, in retail buildings or do we want to be more in multifamily? So we're working on figuring out where we would like to focus as well.
One kind of thought that comes to mind. Now, I don't want to break up the band here, but you had the band prior to this because there was things to do, right? There was operation involved. Obviously, moving to a place where there's really little to none, right? Especially once you know the players, you know the lingo a little bit. The education portion gets out of the way, and I think it would make more sense to split apart because of the extra logistical headaches to make non-operational base activity, if I'm explaining it right. But
Yeah,
yeah, you guys could all invest in the same deals, but individually. And then if somebody doesn't have the cap, it just makes it so much cleaner that way. But I think what you guys have is amazing that you guys have this cohort of guys that it's a motivation to study harder more and learn it more, right? And
yeah.
you cover more.
Well, may come back in a year or two and say we should have split apart and done this on our own. Right now, we have the philosophy of, I think it's in one of Jim Collins' books, he talks about firing bullets and then cannonballs. And I won't go into the full, yeah, Lane, what do you call it when analogy? So I won't
Yeah,
go
no,
into the
no.
full
Yeah,
analogy.
I think this is the thing. What we've seen in 2020 to 2023 is you need to diversify along 4 to 7 years. And for one guy to drop 100 grand every single quarter over 5 years, so 400 grand times five is
Right.
$2 million. Y'all may not have that, especially if you haven't been investing for more than a decade at this point. So by having a little group of homies, 5 guys, each putting in maybe 250,000, 500,000, you're able to get up to that number because the minimum investment on any deal that you want to be doing is at least 50, 100 grand. If not, you're working with a run-of-the-mill newbie syndicator under $1 billion of assets under ownership. Or you're investing in like the crap part of the capital stack in some of these crowdfunding websites. You have to get a certain economies of scale.
Yeah.
I would say what's diversification? It certainly isn't two, three, four, five, six deals. It's more like a dozen or into the dozens. And if you guys are able to deploy a deal or two every quarter, then that's the way you want to go about it. And then initially, like what we see investors do who have that two, $3 million net worth, right? That can do it themselves. Normally what happens is they'll invest with 12 different people out there, right? They'll just spray and pray, right? Although if you have a network of people who've already invested with people in the past, you don't necessarily need to do that, which is why we always say, just join the family office on a mastermind. Yeah, maybe it's expensive for you now, but think of the information that you're going to get, verified referrals. But once you get that initial couple dozen deals, and this is coming from other people, like once you go full cycle, they tend to restrict the number of people they work with from 12 people down to a few people,
Yeah.
and they just
Yeah.
keep hitting them.
And then it's also easy, right? You're not out talking to different operators. You're not having to do a lot of that research yourself because you either got it from the mastermind or you've experienced it yourself.
Yeah.
And it's just rinse and repeat where, yeah, we feel like we're still in a heavy investigative stage, figuring
Yeah.
out who we are and what we want to do.
Yeah, and maybe I shouldn't say this, but then the problem on the next horizon is let's fast forward 4, 5, 6 years. Those operators, if you've chosen good middle market operators, have likely gone institutional
They,
now. Like you guys are a small turnkey provider outfit today, right? Provide good
yeah,
service, but there are turnkey provider out there who will not mention the names. I don't know. I couldn't think of any clever way of saying
Mm.
their names, but these guys will typically pump the price up 20 grand more than what you guys would sell for. Why? Because they got a whole bunch of like unsophisticated investors, retail investors that have done business with them in the past that are too lazy to go and shop the market and even price match. Good for them, right? They built the brand, they built the business, but if you want to keep investing where you're getting really good, strong splits and you don't pay exorbitant fees, some of these operators is 4 or 5% acquisition fees. And then there's other fees on top of that. When you add them all up, that's a bit exorbitant, I think. But hey, if your net worth is $4 or $5 million at that point, maybe who cares? But this is where it is a constant game. And so that's why I tell
Yeah.
people think of it like just catching the wave into shore, right? You're going to go in, you're going to load up your pipeline, and you're going to ride this set of maturing operators to a point to when they do get institutional, you stick with them a little bit. Maybe you put half of the portfolio with more middle market operators. But depending on what your life goals are, if you want 5 million plus, then you're going to have to churn your operators. But if not, then maybe you're exactly where you want to be and just T-bill and chill at that point.
Yeah, so there's not really an end to the finding of good operators unless you're willing to leave some gain on the table or switch to T-bills, and those should be around for the foreseeable future and are relatively easy. But if you're
Right.
yeah, you can't just find 3 syndicators that you like and stick with them for the next 2 decades.
Yeah, it's like the opposite of
That's
marriage, right? What or I don't wanna get political or whatever here, but you think people know what I mean. But that's where specifically for your situation, which may not apply to most people listening here, but you guys do operate, you guys rehab properties, right? Out of your guys' group. You guys got a
yeah.
little bit more on along the way, and you guys renovate properties and you flip them for people, new investors who want to buy turnkeys. You guys aren't doing that nowadays, right?
For background perspective, starting about 5 years ago, my wife and I started the business called Turnkey Iowa, where we were basically using everything we learned in creating our investment group's portfolio and our own portfolio of single family rentals, using everything we've learned there and leveraging it to help other investors. Maybe half of those from the East and West Coast and half of them from the Midwest or the local Iowa area. And you could 5 years ago, you could buy a $100,000 house in Des Moines that we had just renovated, new furnace, AC, hot water heater, roof, all that stuff. So a pretty solid property. It would rent for maybe $1,000 to $1,100, and you could
Class
get a loan
B
for
plus, Class B plus, 1,400 square feet.
we probably made it a B plus property, but in a C plus neighborhood. So that kind of calibration level. And it would cash flow, not change your life cash flow, but you could get, I don't know, $2,000 to $4,000 of cash flow a year from that property. Now the home prices have increased enough. And by the way, we're a fairly linear market. Our prices have gone up relatively modestly compared to a lot of East and West Coast places, Texas, Phoenix, whatever, pick your major cities. It's been pretty modest compared to that, but
But
nonetheless,
pretty
go ahead.
consistent with your Memphises, your Birmingham,
So,
Indianapolis.
so pretty consistent with those. And home values have gone up enough, plus interest rates have gone up enough, and rents have not gone up enough to make the whole picture make as much sense to investors today. So those good positive cash flows are more like zero or honestly a bit negative if you really do an honest pro forma in our local market or many of those other cities we mentioned.
So $100,000 house 5 years ago, renting for $1,000 today would be what?
It's maybe 175,000, maybe, yeah, what,
Renting for 1,200.
1,300,
Yeah.
1,400, yeah, something, yeah.
Yeah.
And
It's
then
just it's this
interest,
gradual dip from 1.1 rent to value multiplier to 0.85, right?
yes. And with interest rates going up, right? You take a $100,000 loan, just an easy example, on that house, and if you have to pay 2 or 3% more interest on that loan, just your interest payments just gobbled up all the cash flow you would have had 5 years ago. All that said, our turnkey activity has slowed down significantly because of that combination of home prices, interest rates, and rents. Those three are always moving and things will change. But right now, the combination of those three have made it a lot less attractive to do turnkey properties.
Yeah. So you've seen the turnkey provider network get blown up. Finding like good, rare turnkey providers that don't pump the price up, just not doing business right now. The perennial guys with the big names that pay the other podcasters a lot of money for referral fees, they can still charge whatever they want, 20 grand over what it should be, because that's what branding and that's what lazy sucker customers trying to get into the market with their first turnkey rental property. That's always going to be there. But yeah, it's just the sign of the times, right? Which is sad, right? Like, how does the 20-year-old dudes in the pub now get started, right? That's the difficult part.
Great question. Yes.
I guess who cares, right? No, no. We're supposed to be helping people here.
Yeah, if I knew what the next decade would bring in terms of profits, returns, benefits, and that would be similar to what real estate has been the last decade, boom, full go. I would do it. But I don't know what five guys in the pub figure out at this point in time. We are optimistic about some of the syndication opportunities in commercial real estate. Commercial real estate has seen price decreases. You've talked about it, Lane. I'm optimistic there's a great time to buy from now through the next year or two. And when we look back on that 5 and 10 years from now, it will have been a great decision.
Yeah, but this is more cigar and whiskey talk right here. Engineers are typically the worst at this because engineers are very pragmatic and analytical. But to be a good investor, and I'm quoting Uncle Buck Joffrey here. I was talking to him the other day. To be a good investor, you need to look at this current situation and recognize the fear and uncertainty and understand this is the best time to be investing right now. It's when all signs are green. That would be what 2021, right? That's when you need
Yeah,
to be
right.
pulling back, right? But this is when it takes the cojones to go in now, and this is when the riches will
Yeah,
be made.
agreed. What asset class is that in, Lane? What do you think is near a low point in the cycle for commercial real estate right now?
Office, office is the one
Office.
that's
Yeah, that's
everybody's
true.
scared of,
You're brave.
but that's in theory, right? You don't know when an asset class goes through some like disruption that is going to change it forever.
Yeah,
Um,
that's the risk, right?
And that's where apartments, I think we're all singing the same song and dance, growing population, lower workforce housing. It makes total sense. But I think the one thing that we might have lost long term is the big reason why we went to real estate in the first place is we were able to get amazing leverage on this stuff over the last decade, maybe a decade plus. And that may or may not be coming back online. So it's this constant search, five guys in a pub for alpha. That's what you're trying to do, right? Trying to beat the market. So where do you get the best alpha? Sometimes it's what is the best other alternative out there. And sometimes, you have to go to the ugly girl dance and just go home with somebody. And maybe that's real estate. I don't know. But,
Yeah.
again, conversations for the five guys in the pub. I don't know. What are your
Yes.
thoughts? Is it still real estate?
Yeah, we're all biased by our history, right? So I've been pretty real estate heavy the last 10 to 15 years, and I still have a lot of confidence in real estate. Yeah, the demographic trends are there. We have really a supply shortage. Like it fundamentally, that's the case. That's good news. Now, within real estate, I'm probably honestly not quite bold enough to go into office right now because I think there might have been a fundamental change in how office is used and what the needs are post COVID. But multifamily dropped significantly in terms of valuations, and we need multifamily. So if I had to pick today, I would go into multifamily. If I was more conservative, maybe some more like commercial, I don't have the word, sorry, not self-storage, but like small
Like
commercial operations, industrial.
industrial, yeah.
Yes. Yes.
Yeah, which is very typical as I talk to a lot of family office folks. They typically expand into different asset classes. Used to be they would go into industrial and office, but obviously you got to have some cojones to do office. But I'm the same way. Look, like I'm showing the home afforded bill and all that type of stuff. This is a page for investors who want the latest news. You can go to thewealthelevator.com/news.
That's great. Lane,
Real
I didn't
estate
know that was there.
Real estate is what brought us here. I also don't want to be that grumpy old guy who just keeps talking about the same thing. I don't want to talk badly about Sam Zell, who just passed away, but that dude was talking about office to his grave. And I think there's group think and biases you need to be aware of, and I'm trying to be aware of it
Yeah.
in
Yeah.
myself. What got me here was 90 to 100% of my net worth in real estate. And I think personally, what I'm trying to do is maybe step back from that a little bit, maybe at least 20, 30% in life insurance. I think that's prudent, especially once you hit your net worth goals or getting above 2 or 3 million net worth. I think you increase that life insurance portion. Life insurance aside, I'm thinking of like buying businesses, getting into more involved in like venture capital type of world. But that's the way I'm looking at it. I think the way that like for Chad's profile, just to point that out for people out there, like he wears two hats. He's an operator of a business and he's an investor too. And sometimes it's important to recognize that being the operator of any business, even though you have extreme confidence and great positioning in your market, is typically a higher risk, more asymmetric play than passive investing. So, in theory, a guy like Chad may want to go into more safer types of investments or even up his life insurance portion of his investment portfolio because he's taking enough like risk, right? Or what do they call it? Beta or something like that on his business side. But if you're just a salary guy, that's very safe. So you need to actually take more risk on the passive investing side
Yeah.
to get you. But yeah, what are
Well,
your thoughts? If it's not real estate, is it throwing money in T-bills or life insurance or any other asset class?
I and our group have looked into buying small businesses. We've gotten hung up on kind of the ownership part that you talked about earlier. So if there's 5 of us, who is responsible for making that business be a success? And we've struggled with how we could manage that. We haven't come to a solution that we all liked. And we've also been concerned about being able to find a good operator. So someone working in the business day to day, not on the business. We would be the working on the business side of things, but in the business day to day, managing what's happening. Whether that's a one employee business or a 50 employee business, our concern has been finding that operator and the accountability in our group to make sure it's being successful.
So if you guys do buy a business or get into that world, the operator is not going to be one of the 5 of you guys then.
That's been part of the discussion, and we've talked about, okay, for one of us 5 to stop one of the businesses or jobs or whatever that we're doing today and be the operator, what's the price tag for that? Because there would be significantly higher risk in that than what most of us are doing today. So we'd almost have to buy or bribe one of us enough to go ahead and be the operator, whether it's with salary or equity. And kind of that balance hasn't been interesting to
Yeah.
anyone so far.
Because y'all are fat, lazy, and high net worth now, right? It's costs a
Trying to
lot.
be.
The only input I would have is if you guys are going to do this, like reshuffle the deck. Don't do it within your guys' pooled fund. Start something
Yeah,
new just for liability reasons because businesses have come with their own like legal liabilities and definitely don't commingle it with passive investments on this
sure.
side of the house. But out of curiosity, out of your guys' portfolio, do you guys own any standard American investment stuff, stocks, funds,
Stock
mutual
fund.
funds?
Yeah, okay. In our group, basically no. Almost
Wait, what was
all.
that? You guys don't own any of that stuff? I thought that we're supposed to do that. No?
I said
Okay.
basically the only caveat is as we've been selling some, we've been freeing up some of these. I mentioned $100,000 chunks of equity, and those are essentially in a money market right now. We deploy them in syndications. So
So
that's the only technical caveat.
So all you
Um,
guys have like less than 10% of traditional investments?
So that's in our investment group. I can say for us personally, like my wife and I, if you combine the real estate we own ourselves and in the investment group, and also the stocks we own, we probably have about a third of our net worth in stocks, quarter to a third, and the rest is in real estate equity. Thinking of equity, not top line value of the properties.
So again, it's hard to get people to break up their portfolio asset allocation mix. For people who grow their net worth in this method, it's very rare that it's even surpasses 50%. I would probably argue that once your net worth goes over 5, 10 million, you may put your money back into that type of stuff because now you're playing the other side of the game where if you passed away, Chad, and your spouse is pretty involved, but like your kids, they adopt all these like alternative assets and you're like, what the heck is this? But I think that's why you do the life insurance, right? Because it's like cold hard cash for them. You really can't mess that up, even without the death
Yeah.
payout.
I think we could spend an hour on this topic, Lane, but a few thoughts on what you just mentioned. So my dad passed away almost a year ago now, very unexpectedly. It was a terrible situation. Good news on the financial side is that my parents were very well prepared in terms of things like having assets in trusts. And for example, my dad was farming, so he was retired from a corporate job and farming corn and soybeans. And I learned things through the process of working through the estate. Wow, it was a really good idea to have the farm assets owned by my dad's trust so they get 100% stepped up cost basis if anything would happen to him. And similar, you mentioned my wife is fairly involved in the real estate stuff we do. Totally, that's not true for all the members of our investment group. And in cases where one spouse is super involved in some obscure business or investment, maybe it is good to make sure they're the 100% owner, or a trust or an LLC that they own are the 100% owner of that for the tax implications and freeing up of the living spouse's mind in terms of, ooh, I don't have to take this huge tax penalty to sell this business or to sell this house or to sell this farm ground. I can do what I want with it.
Yeah.
Now, the life
Some,
insurance helps that too.
yeah,
Cash
regardless of
to,
the death payout, but it's just
yeah,
like a source of money that keeps creating money there. Something that kind of came to mind, like you are a very wealthy man in terms of you have this band of brothers that if you were to pass away or your spouse were, I'm sure these guys not only emotionally but financially can help guide. It's like a village,
yeah,
and you know this, right? That's once you get past a certain net worth point, two, three, four, $5 million. For some people who need to relax a little bit, maybe that's $10 million. It's more like the social relationships are the currency of the wealthy. And if you don't believe that, maybe you need more money. Most people do understand that it's like people around you that kind of swim in the same direction. And like what you guys created with your little band of brothers, like you guys started in the beginning and you grew it this much, and it's very robust relationship and even goes beyond the confines of whatever the NAV is that day or that year. That if anything were to happen to one of you guys financially, that I think the other guys would come in and assist the family
yeah,
there.
totally agree.
But we'll wrap things up there. Anything other you think I think would be useful for the folks in the position?
Yeah. A couple things here, Lane. First, why should I join the mastermind group? What would be the benefit for me? What's the sales pitch for having Chad join the
Oh,
mastermind
I'm really bad at like selling this
group?
thing. Like what we normally have people do is test drive of the organization first, right? That's how we do these events because we allow you
Yeah,
guys to come once, and then that way you see the cultural divide between the people who are in the group and then the newbies who just come once and are asking a whole bunch of questions. Where the people in the FUM are very much like relationship based. Hey, we're here. We're gonna grow the relationship over the next years, hopefully decades, possibly. And there's a lot of investment groups out there, but you don't get that culture, that family environment, right? The Family Office of Hana
yeah,
Mastermind is a group of family offices, and you guys will all become that eventually. You're in your 40s right? And if you're growing your net worth and you give it a few decades, pretty easy to get into the eight figures at that point, and you have a dynasty. Most of us are pretty aware and intentional in the way we talk about money to our kids. Maybe you're not, and maybe you better get on the program, but it's that third generation that is going to need to be around it. And to do that, you need to engulf that next generation into the right network. Like you have your band of brothers now, but your kids don't necessarily have that. I think if anybody,
Yeah.
you wouldn't
Yeah.
really need our group because you seem to have this cohort already. And that's what we provide is we have over 100 people, and the goal is for you to find 5 to 10 ladies or bros in this organization and have that be what you've created on your own, Chad.
Yeah.
Obviously, yours took a lot of heart, sweat, and tears and heck of a lot of time. But that's where I'm just
Right.
trying to make it a little bit easier for
Yes.
everybody who doesn't want to go into the trenches and buy that first single family home with 10 grand from guys and have it mature over a decade or two.
Yeah.
Like we're trying to make it easy for people. Imagine
Yeah.
that, right? But at this point, like I said, what's money, right? You gladly trade 50 grand for a good, strong relationship for a 5 year track record, right? That's how life changes, I
Yeah.
think. Come and try it out. That's what we say.
And yeah, if anybody that sees this video wants to contact me for thoughts, opinions, a discussion, whatever, feel free to do that. Lane, I can get you my contact info. The best place though is Chad, CHAD at turnkeyiowa.com.
Yeah, we'll put that in the show notes and not selling turnkeys at the moment, right? But yeah, definitely open to doing business. I think Chad's always interested in interacting with people and helping other people get started. I think that's where we're definitely aligned on selling the wealth elevator back down to other people. What he will not do is bring you in his a group of five bros because it's too late,
That is
too bad
true.
for you.
Yep, you're 10 to 15 years too late. Sorry. But new networks can form any day.
Your five guys knows they might meet one or two other guys and you bring them in, or it just makes life a lot richer when you start to get to that level. And then that's the thing, right? As your net worth accelerates, there's less and less people there. But as I've always said, it's hard to find people along this journey that are somewhat wealthy, but they weren't born with it, right? And that's our exclusive group is like first generation multimillionaires. But with that, yeah, thanks for jumping on, Chad. I think good we were able to keep dive into these topics. And if you guys got value out of this, like us on YouTube and share the podcast with your friends. And we'll see you guys next time.